GM everyone, and welcome to Smart Contact, an interview series with the world's most influential and impactful Web3 leaders. This podcast is produced by Web3 Harbour and is supported by Circle. Like and subscribe for more Smart Contacts.
Welcome to another episode of Smart Contact, produced by Web3 Harbour. I'm Tchui, head of APAC Ecosystem, Hedera Foundation, and Executive Director of Web3 Harbour. I'm your host today. We're recording with a live audience for today's Smart Contact with James Smith, co-founder, Chief Strategy Officer at Elliptic. Thank you for joining the conversation today.
Thanks for having me.
James, welcome back to Hong Kong.
Thank you.
We were chatting earlier, and it seems like there's many things to love about Hong Kong, with the passion of Elliptic focused on compliance, on-chain forensics. I think we have a lot to talk about today.
Yeah, looking forward to it. And I love being back here.
James, you founded Elliptic in 2013. The world has changed a lot. Hong Kong has changed a lot. The region has adapted. Take us back to the very early days. What was the hardest moment of starting Elliptic? Was it always Elliptic as we know today? And what was that aha moment that you realized blockchain analytics, that's the answer?
Yeah, so if we go back, I was working as a trader. I was working as an options trader for a Chicago-based trading firm. One of my friends from university had told me about Bitcoin in 2011, Tom Robinson, who's one of my co-founders. I ignored it. I thought, I don't want to play with your toy internet money. And then in early 2013, I remember sitting on the trading floor at work and seeing on CNBC the price of Bitcoin had gone from something like $10 to $30. And it caught my interest. And so I started talking to Tom again. And that was the moment where I really fell down the rabbit hole. I'm a technologist by background. I was certainly excited about the technology behind Bitcoin, about the consensus mechanism. But I was also excited about the economics. This felt like a new primitive for a financial system, something that didn't exist at that time. And Tom and I and our other co-founder, Adam, very quickly got excited about this being the future of the financial system. The ecosystem was pretty different back then. We would go to meetups in abandoned warehouses, and if you went into a room wearing a suit, then you were the odd one out. It was very libertarian, quite a lot of anarchists. There's certainly a lot of people that thought this was going to replace or upend the financial system. That wasn't our view. We thought that this was a new tool that was going to be integrated. And so we founded the company trying to work out, with the vision that we were going to work out how we could help build an industry, build an ecosystem that was safe, that was interoperable. We didn't start with this product. The first thing we decided to launch was insured custody for institutions. We believed that institutions who are investing and holding Bitcoin would need somewhere safe to hold it. And we were right, but we were right at the wrong time. Far too early on that. There weren't many institutions around back then. So we built and launched this custody product. We raised our first money off that idea. But within that first year, we realized that wasn't the business we needed to build. There were not that many companies building in crypto at the time. So we got to know founders of places like Circle, Coinbase, Bitstamp, and so on. And they were increasingly starting to get questions, particularly from the US, from FinCEN, about how they knew where the money was coming from. How could they tell whether it was coming from the Silk Road, a drugs marketplace that existed at the time, or whether it was a legitimate use case? And no one really had a good answer to that at the time. As three data nerds, we thought this was a much more interesting problem than trying to lock down crypto in custody. So we started trying to work out what we can infer from this open ledger that is the Bitcoin blockchain. We started doing some data science, starting to attribute some of the wallets that we could see, and start to reason about where's the money coming from, where's it going. That was really the genesis of what's taken us to today. So there was that early pivot about a year in, but since then this has really been the track. And I think what we realized at that point was that if this ecosystem was going to thrive, if you're going to be able to bring in new participants and increasingly mature participants, then there needed to be that trust, that transparency, that ability to understand who you're transacting with and where they got their money from. And that certainly played out over the 12 years or so since then. We're really excited today to count among our investors and customers some of the biggest banks in the world. Recently announced investment from HSBC and a number of other huge global banks are backers and customers of ours. And we wouldn't have got to that point if we hadn't, as an industry, found ways to build that trust and transparency into it. So yeah, very different from where we started, but hopefully we're on the right track now.
I actually do want to stick on that question a little bit, just for a little bit. Congratulations on all of the success and accolades over the years. I also imagine finding that product market fit, though, was not easy in the beginning of the time that you were running Elliptic. But it seems like the three personas you mentioned, customers, investors, and even institutions, they were all really against you. So how did you tell that story? What was that? Did you have three narratives? Like, I'm trying to bring this back to the crypto founders that are trying to deal with the headwinds today. How did you convince three different, very disparate personas to agree that this was the future of blockchain?
Yeah, it's interesting. And it didn't all happen at the same time. I think when we first announced our product, anti-money laundering compliance product, that we built with Coinbase and others right at the beginning, a lot of the industry was against us. They thought this was against the principles of Bitcoin, that you shouldn't be looking at where the money came from or who you're transacting with, that it should all be anonymous. And so we certainly weren't well liked at the beginning. But those businesses that we were working with, Coinbase Circle and so on, they saw the world differently. They saw the world the way that we did, that you have to build this trust. So there were a few early on who shared the same vision as us, but much of the industry did not care to until they had to. A big part of those early years for us was starting to educate regulators, help them understand what's possible. We've seen recently, and maybe we'll come on to this later, that when there is regulation, it can really help fuel growth. But for a very long time, there was almost no regulation around the world, and most regulators didn't want to touch it because they didn't want to legitimize it, or they just didn't understand it. And so we would spend a lot of time, and still do, with regulators around the world, helping them understand what visibility you actually can have with digital assets. There's so much more information there and public information there than there is with most traditional forms of moving money around. So actually you have this incredible wealth of information. So that education piece was really helpful with the regulators. And I think, follows from the regulators starting to get more comfortable, that then you start to be able to get the larger institutions and banks and so on more comfortable. But I think it all starts with education, and that's still a big part of how we partner with companies today, is helping them work out how this works, how digital assets work, how compliance works in digital asset, what data is available in this space, and then how you can build a safe product, a secure product, and a scalable product.
You mentioned regulation, maybe 15, 20 times in the last 90 seconds. And, I kind of want to focus in on that right now. Hong Kong, we're here today, and we've had some really interesting announcements coming on the regulatory side. But we're not here to debate which jurisdiction's better than the other. I think the focus here is, given the regulatory landscape, and then specifically in Asia, not every jurisdiction is created equal. Specifically, Asian jurisdictions are historically very fragmented. So, Elliptic is based in London, has offices in Singapore and Tokyo, has been operating in Asia and is focused on Asia. So asking you the question here, why Asia, and has the fragmentation in Asia over its historical period given you opportunities? And what are you really looking forward to, especially in Hong Kong?
Yeah, I think firstly, Asia has played such a huge role in the development of crypto to date. When I was starting the business, the biggest exchange in the world was Mt. Gox. It was based in Japan. And I think most of the largest exchanges that exist today have come out of this region. There's always been a huge appetite for digital assets in Asia. For us as a business, it's most of those large exchanges customers. They've been huge drivers of our product development, because the appetite for new tokens, new technologies, new blockchains, etc., has been so big amongst the exchanges in Asia that as their partner, we've been driven to make sure that we support everything, that we're adding support quickly for every new innovation that might come along, and make sure that we can give them the visibility that they need. So we've always wanted to make sure that we can service businesses here. We were lucky to take investment from a Japanese bank, SBI, back in 2019, and they were really helpful to us in opening up some markets. It was through sort of seeing what we could do through that partnership that we realized that we needed to establish a larger presence here, and started building out our Singapore office, which has been our base for the Asia Pacific region ever since. And then more recently taken investment from others who have helped us, like HSBC, who have helped us sort of bridge into new markets. Hong Kong, which I love personally as a place to come to, but I also just find it really exciting as a bridge between East and West, in a sense. As a Brit, I sort of feel a long sort of connection in history to Hong Kong. I think it's really exciting to see the crossover between traditional finance, the appetite for Web3 here, like other, some other jurisdictions around the world. Hong Kong's taken that sort of leap of faith in saying that we're going to put some regulations in place. We're going to look at how we can explore this in a way where there are some known controls. And I think that clarity brings some comfort to both small businesses, new businesses, and also mature businesses who want to take a step into a new technology. So I think we could talk about plenty of other places in the world, and obviously this year the big news was the US putting regulation in place. But I think what Hong Kong did had a similar effect to what's going on there. It enables banks to get comfortable and fintechs to get comfortable and to start thinking about how can I leverage this in a way that complies with the regulation.
When you walk into in the region, when you walk into a meeting with a regulator, do they support you? Like, do they have an ask for you, or do you go to them with solutions that can make their work easier? I guess you want to say.
I think most of the conversations we've had with regulators over the past decade plus have been them looking for information, education. The best way forward here is always that public-private partnership, sort of working together to work out what the answer is. Like this is a space that evolves so quickly. If anyone puts some regulation in place, it's going to be out of date a year later, or it will need some modification. And I think the only way that we've seen is sort of healthy is to provide a framework that is sort of open to iteration and evolution. And that has to be done through constant consultation. We get to play a sort of a unique role in a sense, in that we're not looking to get licensed by the regulator, but our customers are. And so we can sit in between, and we can talk to regulators, help them understand what's going on in the market. We can talk to the market and help them understand what's going on with regulators. And crucially, we can bring that data that helps both sides understand what's really happening on chain.
Earlier you said, some of the biggest projects came out of Asia, but some of the biggest scams also come out of Asia, right? So in your 2025 crypto scams report, it paints a pretty stark, dark picture. $9.3 billion lost alone last year. What's one or maybe many scam trends that's on top of mind for you, for not only the region, but globally? And if you want to talk about maybe one of the more recent ones, Bybit, and how is that one uniquely different? And how did Elliptic kind of handle that one?
Yeah, sure. So I think firstly, it's worth saying with scams, that it's not that crypto's enabling new scams. It's just helping scale old scams. We've seen things like romance scams, elderly scams, etc., which have been perpetrated everywhere, and crypto is just the new battleground. I think that number, the US number of 9.6 billion, was accounted for more than 50% of reported fraud in the US that was crypto related. So it's certainly a big feature. Our team has been instrumental in uncovering and dismantling some really large fraud networks this year. So there were a couple of guarantee groups based in Asia, one called Hui Guarantee and one called I think Xinbi, guarantee. And these are platforms where they operate out of a network of Telegram groups, somewhat decentralized, and they will sell a lot of pretty horrible things, starting with software to help scam people and all of the frameworks you need, but even down to some of the sort of torture equipment and so on that they're using in the compounds where they're operating these scams from. We estimated about 30 billion had gone through these two marketplaces alone. So certainly the organized crime sort of scale of scams is pretty huge. Yeah, you mentioned Bybit. Also really interesting to see in that one. What I think is interesting is the sort of professionalization of the money laundering. Right? So as we know, DPRK stole $1.5 billion from Bybit in one single go, which is pretty incredible. And they've effectively laundered that money at this point. $1.5 billion was laundered by using DeFi protocols predominantly. So they played a huge role in that. So going through DEXs initially, whenever they steal tokens, they very quickly try and convert them into a native token so that they can't be blocked. And then they moved them, in this case, from Ethereum over into Bitcoin, and they used a decentralized bridge to do that. I think there's some lessons to be learned there for us as an industry. And if we want to be able to scale DeFi and build that trust and transparency in DeFi, we need to ensure that liquidity isn't there when a prolific bad actor is trying to launder their money. Everyone who's providing liquidity in those pools was part of that money laundering process. So we do see that chain hopping, that protocol hopping being a really common typology now in financial crime, in money laundering. I think something like a third of our investigations now involve at least 3 blockchains. Gone are the days where everyone relied on a Bitcoin mixer. Now it's just much quicker to hop across a couple of bridges and then cash out an exchange or an OTC broker.
Sorry to interrupt, but I want to tell you about our smart contract lead sponsor, Circle.
What is Circle?
At Circle, we're building a digital dollar that brings the power of the internet to money.
Circle's the place where crypto meets stability,
where local businesses meet global customers,
and the US dollar meets USDC.
Meet Circle.
Thank you to all of our sponsors and community partners. Now back to the conversation.
I'm actually a little bit more curious on this next question. It's a follow-up on what you just talked about. And okay, without disclosing too much, sensitive information or any secret sauce of how Elliptic works under the hood, how do you do that? How do you trace hops? Do you sit in a war room? Do you have a bunch of very smart people looking at things? Do you use automation? Walk us through it. How does it actually work?
Yeah, sure. So obviously a lot of it is automated. Right? We build a real-time data intelligence platform that supports currently nearly 60 different blockchains, where we're ingesting every single transaction across all of those blockchains into a single unified data set. We're also watching every bridge transaction and DEX transaction to make sure that we're capturing all of these movements between across bridges, between chains and so on. Pulling all of that together, aggregating that, building this big map of wallets so that when someone's asking a question about a particular wallet, we can trace in real time across the network and see what it has strong connections to. We have a research team that's going out and doing things like discovering these scam marketplaces and making sure that we're documenting them and building that intelligence layer on top of the graph. We also have a huge number of customers. So we have about 700 customers globally, and they'll all be helping sort of feed information back into it. So many of them have Intel teams themselves, and where they find something interesting, they share that with us because it helps the whole community to build up that knowledge base. So this knowledge base is really the heart of it. But then when you have something like the Bybit hack, you do have to get in a war room and figure out how we can sort of bring people together and do something a bit differently. We had our teams doing shifts around the clock. We were constantly in communication with the Bybit team. We actually opened up a free data feed of every address that was associated, which is a constantly expanding list that was associated with North Korea in that particular hack, because they were just layering through wallet after wallet as quickly as possible. And so we just wanted to help the industry to have easy access to information of wallets you should try not to touch. In that case, some of the money got captured, but a large amount of it got laundered. I hope through doing that, we've at least shown the industry that working together, we're going to be more productive. And I think that was the blueprint for hopefully next time we'll do better. We'll all come together faster, and there'll be more participants involved. But yeah, so it's in those crunch moments, you do need to all just roll up your sleeves and work out what you can do differently. But most of the time, hopefully, it just runs in the background.
Those innovations, those best practices, right? Are those standards in the industry? Like, is there a data sharing framework amongst exchanges, amongst forensic companies, amongst regulators to prevent this from happening again? Like, is it something that Elliptic is working on?
It's something we're working on. I would say that there's no standard across the industry. I think we've gone through so many incidents over the years, right? And I'd say actually, I think the industry handled the Bybit theft in a much more mature way than many previous incidents. But we obviously still have a long way to go. I think finding those partnerships and building those public-private partnerships and private-private partnerships is really key. I also just think education, making sure that everyone's aware of what is possible is really important. As I said earlier, so much was laundered through these DeFi protocols where the liquidity providers were just making money off that. I don't know whether they knew or they didn't know, but they probably should have been monitoring and making sure that they were watching whose money they were helping change. And then I think the other piece that has to go with that is iteration on regulation. There's not yet much clear regulation around DeFi, and I know DeFi is still in its early phases compared to where we'll be in a few years' time. But I think what we will see is more in terms of guidelines and regulations around what the different participants in that ecosystem should be doing. And I think that will help get everyone closer to a common standard.
Could you talk about some of those partnerships? Let's say, since we're in Hong Kong, maybe recently HSBC, or anything related to the Hong Kong ecosystem that you'd like to highlight? And then specifically around privacy versus transparency.
Yeah, privacy versus transparency is certainly interesting tension that has always existed. People thought Bitcoin was anonymous at the beginning, but actually some people thought that. It's actually a totally public ledger, right? Every transaction is recorded. You obviously do want to be able to have some financial privacy, but most of us, I think, also want to ensure that bad actors are kept out of the ecosystem. So there is a sort of constant tension and balance that you have to find between those two things. Some of our customers are working on more private transactions on chains, and so we're working with them to make sure that the visibility is there for the people who do need to be able to see it, which might be regulators, might be law enforcement, might be auditors, might be compliance vendors, but not there for the general public so that everyone can see where you bought your coffee from this morning. So I think there's going to be some interesting developments in that privacy space and making sure that the right data and analytics is there to be able to support the privacy is going to be key to that. I think in terms of the Hong Kong ecosystem, it's been exciting to see fairly quick progression over the last few years from initial licensing coming out and then implementation and now the stablecoin regulations as well. It's great to see something being put in place so that people can start coming in, especially with the stablecoin regulation, some fairly large participants coming in to try and work out what their business model can be, how they can test it here in a sandbox type environment, but then thinking about how they expand out beyond Hong Kong. And so hopefully you'll see some incredible innovation born here and then shipped out to the world.
Fantastic. Innovation. Elliptic focuses on decisioning over just detection. With that vision, how much of 2026 will be focused on new technologies, new trends? And let's talk about the elephant in the room, AI. Like how are you integrating AI into opportunities here in the region and into the tools that Elliptic is actually evolving?
Yeah, AI is interesting because obviously the bad actors use it as well. So maybe I'll start there and then come on to what our plans are. We've seen a definite increase in the use of AI by bad actors in digital assets. And this could be, I mentioned on the the marketplaces. You'll see people selling software for doing deep fakes, for doing live video, changing your face on live video, for trading bots, fake trading bots to create volume that's not there. All sorts of different things. And so there's certainly innovation coming from the criminals. We, at our heart, we're a sort of deep data engineering, data science company. So AI and ML has been a big part of our history and is certainly an even bigger part of our future. For a long time, we've used machine learning techniques to try and identify patterns of activity across the many different blockchains that we look at, to try and work out intent, who's transacting with whom. Our customers now, which are particularly the largest transactors in the world, think of the large exchanges and wallets and fintechs and so on. As you'd expect, they're all increasingly trying to work out how they can use AI to reduce the human workload in their compliance processes. Lots of alerts that they're looking at how they can close these more automatically. So a big part of our roadmap is building out some of the tooling for that. In March or April this year, we launched the first version of Elliptic Copilot, which is part of our compliance suite and helps the analysts to very quickly understand what's going on and make faster decisions in that triage phase. And the evolution of that for us is to take it from being the support to the analyst to actually helping make the decision for the analyst. We're a big believer in building agentic workflows that use the amazing data set that we've built to help make the decisions on behalf of the customer within the controls of their system. So you'll certainly see a lot more of that coming from us over the coming months.
Yeah, over this year, I've heard many times different people have I won't name them, but different people have said maybe DeFi wasn't really meant for humans. It was really meant for AI, right? Trading 24/7, 365, nonstop. So let me ask you this: how do you feel specifically about that statement? And there's a lot to unpack there. And then specifically in the DeFi space, do you treat it differently as a product offering or Elliptic's product suite addressing DeFi than traditional CeFi activities?
The statement's it's probably got a lot of truth to it. You could certainly see people building agents that start trading. Now, for anyone who's actually had to build and tune a machine learning model at any point, you'll know that the vision and then the path to getting there can be quite different things. And I don't think it's going to be that overnight everybody's able to suddenly create an agent that makes them lots of money. I think that we'll see lots of experiments and we'll certainly see some changes in behavior where it's not got the sort of weaknesses of a human in terms of having to go to sleep and observe other human behaviors. So perhaps trading patterns will change over time. But I also think that it's not a huge shift in that many of the high frequency traders and people who've been building trading firms for years have been looking at techniques that we could call ML or AI, and I think this is really just an evolution. If you look at that DeFi versus CeFi, there are differences in terms of what's observable to start with. So what I think is a real strength of DeFi is that everything's recorded on chain. That transparency brings lots of great features. With CeFi, an exchange essentially operates as a big mixer, and you have to trust that the exchange is fulfilling all of their obligations to their regulator. Whereas with DeFi, it's all written there on chain, and so in a sense more auditable. That said, it does produce more complex patterns, and the composability means that things can happen very quickly. And some of the flash crashes we've seen have been where someone has composed together a few different DeFi protocols, and it's come with unexpected consequences. So I think it's really important, if we're going to see more activity shift into DeFi, that we're providing the right observability, that we're helping people understand how to interpret the data, what to do with the data, and to make sure they're making safe decisions. If we're going to have this world where agents are running around doing everything, we've got to have the right frameworks to be able to control those agents. Otherwise, it's not going to end well for any of us in the meat space.
Yeah. The agents really need Data is their lifeblood, as you mentioned, right? So not an East versus West or tariffs or data security issues, but there will be situations where we inherently create more and more data silos just because of the geopolitics of our current times. So how do you filter that noise out, right? So you have a lot of data that's coming in potentially from multiple different sources. You have new asset classes that would require different amounts of data, whether they're ESG products, impact instruments, or deep pin solutions. So do you have, or will you be looking at different products related to data management alongside forensics and tracking and tracing?
So we see ourselves as a data and intelligence platform for digital assets. We spend most of our time today in financial crime compliance, but that's certainly not everything we have planned for the future. We're very led by our customers, and so we will continue to try and build the data and visibility that our customers need, and that's driven us to add many blockchains in the past and many assets. It will increasingly involve us adding real-world assets and whatever else might be required. I do think, though, that you will continue, as you do in most industries, to see data specialists in different areas. There will be certain niches that are served by highly specialized businesses, which is not our goal. We hope to continue to be this sort of more general data platform that serves a wide set of customers. I think the geopolitical angle is certainly a really interesting one. We're lucky at the moment to have a fairly global spread of customers. Our revenue is split fairly evenly between the Americas, EMEA, and Asia Pacific. And so, as I said earlier, we learn a lot from our customers, how our customers feeding data to us. So hopefully we're somewhat insulated from some of those geopolitical silos.
Okay, fantastic. As we approach our end of the podcast, I do want to, ask you what gaps you still find are present in the industry, and what are some areas that you would, if you could, would love to solve today?
I love the idea of DeFi. I'm really excited about it as a set of primitives to build new products. I think that it will be the way that we transact many different assets, but I feel that it's still pretty immature today. It's not yet at sort of institutional grade. So I want to see more liquidity coming into DeFi, which will give it more of a battle testing. I don't think, though, we're going to bring the large institutions into DeFi until we can build up some of the trust layer there. We need to be able to have the right guardrails, the right industry standards that enable us to have visibility on who's trading in these venues, or what types of actors are trading in these venues, what types of activity are legitimate versus unsafe, and make sure that it's as I said earlier, might require this regulation as well to help put some guardrails around it. But I think it's in everybody's interest who has a stake in the DeFi world to work out how we can build that visibility and those frameworks to make it safer. Yeah, I'm excited to see the day when the biggest banks in the world are operating in public pools on chain. But I think we've still got some work to do together.
My final question to you: what are you looking forward to in 2026?
I think 2026 is going to be a lot more of what we've seen in 2025, which for me has been massive growth in stable coins in terms of real payments being made. The number of businesses who are actually now seeing that this is a cheaper, faster way to operate across the world. The change in our client base this year has been incredible, seeing the number of payments companies, large banks and so on come and operate. And I think we're going to see this year, perhaps it was the leaders jumping in early. I think next year we're going to see a big wave of the fast followers.
Amazing. James, thank you so much for joining us today.
Thanks for having me. It's been a pleasure.
Fantastic conversation. I hope you enjoy Hong Kong, and join us for the next episode of Smart Contact. Thank you.